This is EnRich Your Life, a podcast about financial health, life planning, and smart decisions with Rich Leimgruber.
Hello and welcome to EnRich Your Life podcast. I'm your host, Rich Leimgruber. This is the podcast where we help you understand basic and advanced financial strategies to help you ensure that you're doing what you need to do for your financial life. We're going to have a deep dive into advanced estate planning. We've already done a podcast on basic estate planning and what a will is and why would you need one and vice versa. But today is more geared to more of a high net worth person, somebody who might have some more complex situations. We take a deep dive into some advanced estate planning strategies and the tools that help you avoid probate, reduce your estate taxes, protect your wealth, and also ensure that you leave a legacy to those that you want to leave it to. Whether you're planning for a second marriage, caring for special needs child, or just trying to understand what a revocable living trust is, a dynasty trust, charitable remainder trusts, or even an irrevocable life insurance trust, this episode you should listen to. Joining me today is Kylan Johnson, founder of Hudson Valley Estate Planning. He's an experienced estate planning attorney who helps individuals and families protect their assets, minimize estate taxes, and plan for the future with clarity. From probate avoidance to advanced trust strategies, Kylan brings a practical, forward-thinking approach to building and preserving legacies. So welcome. With no further ado, welcome, Kylan. Great to see you again. Thanks for coming on.
Thank you so much, Rich. Very glad to be here.
I'd like to ask most of my guests, how did you get into this? What was your backstory?
Yeah, absolutely. So really two things about my background drew me to estate planning. The first is that I'm actually the son and grandson of a funeral director.
Oh.
And I actually grew up in a funeral home, working in a funeral home. If you've ever seen the movie My Girl, that's very reminiscent of what my experience was in a small farm town in central Illinois. And so you could tell even when I was a young kid, you can go to a visitation, go to a funeral, and you can see the families who have it together and the families who don't. Uh-huh. And so that was from an early age, that was imprinted upon me. The second thing that drew me to estate planning was my grandmother developed vascular dementia. She was diagnosed later in life, but my grandmother was my biggest fan in my life. She was at every recital, every baseball game, everything.
Wow.
And but unfortunately, when I was 20 years old, going through undergrad, getting ready for law school, she was diagnosed with vascular dementia, and she lived with that for 5 years. Yeah. But she needed 24/7, 365 care in a community. Unfortunately, she had lived with us for several years. We could not take care of her anymore. And so at that point, I really learned how expensive memory care is, or any sort of community care. And, you know, my grandmother would be at lunch and we would go and visit her. And she would make a friend, and then 3 months later, that friend wouldn't be there. And I would ask my mom, where did Lois go, or whatever? And it was, well, Lois's family ran out of money. Uh-huh. And so I learned then not just how expensive it is, but how ill-prepared people are. And that is only becoming more and more acute as, my grandmother's generation had pensions.
Yeah.
Had savings. It was the Great Depression generation. They put money in the mattress, right?
Yeah,
our world has changed. Yeah. Most people don't have pensions anymore. Most people are not saving enough. And that's, those two experiences really imprinted upon me how important it is to get your estate plan done.
Sure.
And obviously now being in this area, dealing with clients in all manners of life, every day I see how important it really is.
Right. Well, what a story, huh? And I'm sure that helps every single day meeting with new clients. My grandmother meant the world to me, and my grandmother actually got ill as well, and I saw her demise go pretty quickly. And, she was at home, and we had aides coming in. Unfortunately, my parents couldn't afford that much as well, so we did the best that we could do. I think estate planning is something that most people don't necessarily need to do, but at the same point in time, if you did, the end result is going to be a lot better for you because you're going to get what you actually want, right? We all know basic estate planning as far as, having a will, having a power of attorney, having guardianships for your kids, right? But as we grow, we build our wealth. Yeah. And we also determine some people decide that their first marriage wasn't the right person.
Sure.
And then they get remarried, hopefully, and they might have two sets of children from two different spouses, right? And gets a little bit more complex. You might have an aging parent if we're in a sandwich generation, right? So there's a lot more advanced strategies that we're going to be touching upon. And some are to save money on taxes, estate planning of taxes, right?
Absolutely.
Some are to control your wealth if you should no longer be here so that your kids don't go out and spend all your money. God forbid something should happen to you, right?
Sure.
Protecting your wealth and then also, preserving it for future generations or maybe even making some sort of a generational gifting to your children, right? So let's take a deep dive into some of those strategies. And number one I want to touch upon today is to avoid your state taxes or protect your wealth.
Sure.
And since the Tax and Jobs Act of 2017, the estate planning exemption on the federal side actually doubled, right? So from an estate planning standpoint, the federal tax exemption has gone up. And then now recently with the passage of the new Big Beautiful Act, which passed on July 4th of this year, the exemptions were also increased, but it's now also indexed for inflation, my understanding, right?
That is correct.
So what are the current exemptions from the estate planning federally and then here locally in New York State?
So 2025, we're talking about on the federal side, it's $14 million per person. On the state side, it is $7.1 million. So we're in New York State tax, it's $7.1 million.
Got it.
Unfortunately, that's not the end of the story, right?
Yeah.
If it was, I wouldn't have a job. So on the New York State side, once you get to $7.5 million in taxable estate, you fall off what's called the cliff, where your entire estate from $1 to dollar last is taxed. So you basically lose that exemption.
So the 7.1 that you might have gotten is now washed out.
And so in New York State, the estate tax rate is 16%.
Okay.
And so from $1 to dollar last, 16%. Under federal law, that $14 million figure that I gave you, anything under that $14 million is exempt, and then there are some additional exemptions that are available as well.
So why did I guess you couldn't answer why New York State does that, but I'm assuming it's because they need money, right?
Well, so initially, they were tracking to what the federal limit was going or threshold was going to be, and then when the 2017 Act was passed, New York State decided not to continue to do that. And so that $7.1 million is really, had the 2017 Act not ever gone into effect, that's where the federal rate would really be. They've just tracked, New York State has just tracked that with inflation. On the federal side, there's been some congressional acts to continue to increase it much more than inflation.
If I were somebody with, sitting on $14 million here in Mamaroneck, New York, what are the tools that I could potentially use to avoid those estate planning taxes?
Yeah, so the first thing to know is that anything that you give to your spouse when you pass away, or anything that you give to charity, is not counted toward that $14 million. So a lot of times what ends up happening is, I call the estate tax often a widow's tax, where husband passes away. Actuarially, we're going to go first, right? Husband passes away, leaves everything to his spouse. The spouse is not going to pay estate tax on at that time, but then when the spouse passes away, assuming she doesn't get remarried in this scenario, when the spouse passes away, that's where the tax is going to get hit. Because without a spouse, without leaving significant amounts to charity, when she tries to pass things on to her children or grandchildren, whatever it may be, that's where the taxable event is going to occur. It's interesting, in recent years, there have been a lot of sports teams, particularly in the NFL, where the owner, male, has passed away, left the team to his wife, who's also elderly, and then there have been a ton of fights within some of these NFL ownership families about when to sell because mom is going to pass away. And at that time, the Denver Broncos are now worth $6 billion. They used to be worth $100 million. And so obviously a massive, 40% federal estate tax on a $6 billion football team is a wallop of a tax.
Sure.
That just gives you an example of kind of the power of that initial spousal exemption.
So now it would be $14 million for the husband, $14 million for the wife. That's $28 million federally.
Million. Yes.
And then $14.2 million for New York State.
So unfortunately, under New York State does not have what's called portability. So that with a married spouse under federal law, you have the ability to add 14 plus 14. Okay. So in my scenario that I used earlier, when the wife passes away, husband passed everything to her, so he didn't use any of his $14 million. She gets his 14 plus her own.
Right.
So now she has $28 million estate tax free to pass on to her children. If that woman lived in New York State, she doesn't get her husband's $7.1 million exemption. She only has her own. So assuming she did no estate planning, then from $1 to $28 million, her estate would be taxed at 16%. And so unfortunately, New York State does not have that portability.
So there would be no tax due, though, at the husband's passing.
Yes, at the husband's passing.
He doesn't get that 7.1.
But he can't, but by virtue of that, he does not get to pass on his 7.1 to his wife.
I understand.
Yeah.
So is that what, we looked at, spousal lifetime access trusts, SLATs?
Yeah. So the other mechanism, so you can gift money to your wife upon your death. You can gift money to charity upon your death. The third most popular mechanism is to gift assets of any sort to an irrevocable trust.
Okay.
And an irrevocable trust, then there are multiple different types of irrevocable trusts that you can use depending on what you're trying to accomplish. One of them is the SLAT, the Spousal Lifetime Access Trust. That is an irrevocable trust where you take assets and you title them, you transfer the ownership of them to the trust.
Prior to death.
You have a independent trustee, oftentimes, managing those assets. They could be stock, could be real estate, could be cash. And the wife is the initial beneficiary of that trust. The beauty of that is that as long as you're still married and in good relations, you are getting indirect benefit from that trust. So when the spouse goes to the trustee and says, hey, I'd like $20,000 to take a European vacation, if you're on the vacation where the $20,000 is being spent, you're getting an indirect benefit from that, but it's not taxable. It's totally kosher from an estate tax perspective. Then when spouse passes away, anything left in that trust, the secondary beneficiaries on that trust can be your children.
Okay.
And everything that's in that trust that goes to those children is estate tax free.
And one of the things that sometimes I have to explain to those who don't know the difference between irrevocable and revocable is that revocable remains in your name. It remains in your Social Security number.
Correct.
It's part of your estate.
Mm-hmm.
But when you move it into an irrevocable, it's its own entity. It has its own tax ID.
Correct.
And therefore, it doesn't apply to any of the rules for your Social Security number with the wealth that you have, right?
Yes.
However, you do lose the ability to use that money, right?
Yeah, you lose control and benefit oftentimes. It depends on the type of the trust and depends on what you're trying to accomplish. But the big thing is to reduce what are called incidents of ownership under the tax law.
Yeah.
And two of those incidents are you controlling that asset? Are you benefiting from that asset? Yeah. Anything that you give to irrevocable trust, you have to be very comfortable with the idea, I'm not managing this anymore. I'm not directly benefiting from it anymore.
And obviously, if you're meeting with somebody, you're giving them enough space to say, hey, you're going to have this other money that, you're going to get taxed on it, but at least this money is now protected, right?
Absolutely.
Let's touch a little bit about the irrevocable life insurance trusts. Why would you want one of those?
Unfortunately, under federal estate tax law, if somebody passes away and their insurance policy is not owned by an irrevocable trust, the death benefit from that life insurance policy is considered part of their taxable estate. So if I pass away, I've got a $2 million life insurance policy. Technically, I pass away and then it goes to my wife. Technically, it's still considered part of my estate.
Income tax free to
Income
the
tax free,
beneficiary, but not
estate
tax free.
Right. So there's different taxes you got to be worried about. So the beauty of an ILIT is that you can either gift your existing life insurance policy, or you can establish a trust that takes a life insurance policy out on your life. You remove those incidents of ownership. You no longer own that life insurance policy. And so when you pass away, that death benefit is not included in your taxable estate and thus will pass on estate tax-free. Yeah. I encourage this for, even in the life insurance world, even small amounts of money, $5 million or less, not just for, policies that are 60 million or whatever it may be.
Sure.
It makes a lot of sense for a lot of people, particularly high net worth people, ultra high net worth people, to use that ILIT mechanism to pass that wealth on. The other thing about it is that, sometimes no matter how much planning you do, you want to have a little bit of control. You want some cash flow. You're funding a lifestyle, and unfortunately, you have a sudden illness, sudden death. So you may have some money left in your taxable estate. You may be over these thresholds that we talked about. Mm-hmm. Oftentimes, ILITs are used to give immediate liquidity to your heirs to be able to pay those estate taxes. Yeah. So they're really not out any money. The insurance company, let's say you got a $2 million estate tax bill, you just got $2 million from the insurance company. Now your heirs are using that to pay the IRS or New York State. Your heirs really aren't out any money.
Yeah, and this always brings me back to folks when there's new regulation and they say they're going to increase the tax on the wealthy. Mm-hmm, mm-hmm. Yeah, if you're not doing the proper planning. But then there's estate planning strategies like the one you just represented to say, if you're in good health and you can apply for life insurance and the insurance company is willing to underwrite you and get you insured, most people of wealth will use those types of strategies to actually say, well, that's fine. We're just going to buy some life insurance and pay for those taxes with that because we have the ability to afford the premiums today.
Yes.
Right? Getting to premiums, can you fund an ILIT with term insurance and whole life insurance or whole life or vice versa?
You can use both.
Okay.
Obviously, if it's term insurance, you want to be cognizant of when those terms are running out, your ability to maintain insurability, to potentially convert those policies or take out new policies down the road. You got to be a little bit cognizant of that.
Yeah.
But again, it sort of depends on what your goals are in terms of what type of policy you want to take out. But in terms of the ILIT, it works for both types of policies.
Yeah, I mean, I think there was always that question before these estate tax laws became permanent with this new tax act, right? Mm-hmm. That you would want a permanent policy because if it runs out, if this estate if the law sunsets, I almost said sunshine, but if the law sunsets, now we're going back to the originals, and there's going to be a lot more estate tax to have to pay. But with this new permanent of the new tax act, that should hopefully allow people to utilize the term insurance a little bit more, I would say, and save a little bit of money, hopefully. So we also talked a little bit about dynasty trusts. Can you give us a little example of that?
That can be used in sort of multiple with different types of assets, but that is an irrevocable trust where you are hiring an independent trustee, and that independent trustee is in a state that does not have what's called the rule against perpetuities, which enables you to have a trust that continues on for many, many, many generations, potentially forever. So there are states like South Dakota, Nevada, Alaska that have very favorable trust laws. Right. And so so let's say it's, with real estate, your real estate is domiciled in whatever state that's in, right? Yep. So if it happens to be in Nevada, great. If it's in New York, however, we do have a rule against perpetuities as it relates to that property. So let's take stock or life insurance policies. Those can be domiciled wherever those accounts are held. And so with a dynasty trust, you establish that trust, let's say in the state of Nevada. You transfer your stock to that trust in the state of Nevada. You transfer your life insurance to that trust in the state of Nevada. And then when you pass away, you're not facing any estate tax because it's in the irrevocable trust. To the extent that any of the assets that you're putting in that trust are actually earning income, in a state like Nevada, they don't have any state income tax. So you're avoiding estate tax, you're avoiding income tax, and you are able to control that money for much, much longer in some of these states where they have no limit on how long a trust can last. It can go on for generations and generations. And so you can be literally controlling from beyond the grave.
Wow. So when you're setting up those trusts, though, you don't have to be in that state. You can just say, I want this trust to be domiciled in the state of Nevada.
Correct. So you can domicile in the state of Nevada. You will often hire a trust company that's based in the state of Nevada.
Yep.
The trustee is in Nevada. You literally are moving the stock to an account that's in Nevada, moving the insurance policy to being to the address of that trustee or trust in the state of Nevada. And so it for all intents and purposes, it is domiciled. That property is domiciled in the state of Nevada, and then it gets all of those tax benefits.
So we always talk about pros, but what is a con? Why wouldn't somebody set one up?
Well, so first off, if you're heavy in real estate, it doesn't do much good for you, right? Because your real estate is domiciled wherever it is on Earth. Some of the other reasons to not do it is cash flow. So if you need whatever assets, I always tell people if they're going to place something into an irrevocable trust, it better be money they're not going to miss. Right?
Yep.
So if you need that money to fund your lifestyle for cash flow purposes, don't place it into an irrevocable trust. But other than that, it depends on how much control you want to have and how long you want to perpetuate that and ultimately, really how much wealth you have. And there are some examples of celebrities and things like that have used these to great effect.
Great. Thank you. That was impactful for me. You mentioned, or we talked about how to protect your wealth. Mm-hmm. And we have people, unfortunately, that are in that sandwich generation where they're helping maybe a parent with dementia or, or maybe they have a child that has some sort of a disability. Mm-hmm. So what planning can you do for those who are, looking to maintain their wealth without losing the benefits that might come from a government for a disabled child or a parent?
Let's talk about elderly folks first.
Sure.
Okay. So if you get in a situation where you need a home health aide or you need to go into a senior living community, there's 3 ways to pay for that. One is out of pocket. And these days, you better have cash flow to do that, right? My grandmother with memory care in the community where we live, that would cost at least $15,000 a month. So times 12, $180,000 a year. Mm-hmm. Most people don't have that kind of cash flow, right? Yeah. To be able to fund that plus everything else that they have in life. The second is long-term care insurance. So you may have been wise enough before you turned 50, 55 or whatever in your life to take out a long-term care insurance policy that would pay for or pay a portion of whatever care you now need, right?
Right.
To the extent that you don't have those 2 things, either in isolation or in combination, the third route is to qualify for Medicaid to cover your long-term care. So Medicaid's often in the news, and it's often about the health insurance portion of Medicaid, health insurance for low-income people. There's a second, lesser-known component of Medicaid, which is for people that are 65 and older to be able to fund their long-term care, provides for their long-term care either in the home or going into a community. There are 3 tests under Medicaid. You need to need medically. You need to have a relatively low amount of income, and then you need to have a very low amount of assets. Yeah. And I do this all day, every day with people. Most people, the asset test is where they struggle. And so you can use an irrevocable trust to get assets out of your name and then get below that asset threshold from a Medicaid calculation perspective. And so that's called a Medicaid Asset Protection Trust. Right. And so those trusts are used to oftentimes real estate. These days, as we've had this massive run-up in real estate, a lot of seniors are sort of house poor. Sure. Now, maybe they got Social Security, maybe they were a teacher, they got a little bit of pension or whatever, but they look wealthy. If you did a net worth form or whatever, they look wealthy because their home is now worth a lot. But they've had that home forever. They don't want to lose that home. They intended to pass that home on to their children. Yeah. And it's not an easy thing to get cash flow out of. That
you just brought up something that I wanted to ask you for the listeners as well. is one of the biggest mistakes I think that somebody might make is they might say, we're going to need money to help mom for the rest of her life in long-term care, and they sell the house. And then they move them into maybe their house, or maybe they get a rental. And my understanding, and maybe you can confirm this, is that when you sell that house, Medicaid allows that person to keep a primary residence, whether it's worth $1 million, $5 million, or what have you, right? So they wouldn't necessarily need to sell it.
So the way that works is, so I actually think I 99 times out of 100, I counsel my clients not to sell their home, and for a couple of reasons. One is from an eligibility perspective under Medicaid. If your home is worth, in New York State, if your home is worth roughly less than $1.1 million, it is exempt from the eligibility calculation. Okay. So that's not going to count against the asset threshold that Medicaid has. However, it is subject to liens from Medicaid. So Medicaid, really the proper way that Medicaid sort of thinks of itself and that you should think about it is that it's a cash advance to pay for your long-term care.
Okay.
And when you pass away, if you have a probate estate, so if you pass away, you have no trust, no irrevocable trust, you've got a will, and when your heirs go to probate that will, the government's going to come in and say, hey, we paid $1 million for Kylan's grandma to get memory care. We're placing a lien against grandma's estate, and they're the government, their first creditor. And so oftentimes when it ends up happening, let's say grandma had $1 million house, she got $1 million of care from Medicaid, Medicaid will basically take that house as a result. You got to clear the lien on that estate, and that's on the property in that estate. And so the house will end up getting sold, and the proceeds will not go to your family. They will go to the state. The other thing that's really great about, especially now that we've had this massive run-up in real estate, about an irrevocable trust for purposes of Medicaid, is that you preserve the ability to get step-up in basis on your home for your heirs. So let's say this happens a lot. Grandma bought a house in Mamaroneck in 1968 for $30,000. It's now worth $2 million. If grandma just gives that house to me, I get it at a $30,000 tax level. So when I go and then I don't want the house, I go and sell it, I'm going to pay capital gains tax on the difference between $30,000 and $2 million. I'm going to get absolutely walloped on that transaction. However, if grandma places that home into an irrevocable trust, when grandma passes away and I inherit that home, I get it at the $2 million valuation level. So when then the next day after the funeral, day after I go and sell the home, I'll pay virtually no capital gains tax because it will be as if I bought that home for $2 million, then sold it for $2 million, no capital gains tax on that transaction.
That's a step up in basis.
That's that step up in basis. So it's very, very important. So most of the time, I encourage seniors to keep their home because we can get it out of the taxable estate. We can preserve that step up in basis. Every once in a while, somebody will be in an emergency situation where I will counsel something different. But the vast majority of the time, it makes a lot more sense to place that home into irrevocable trust than to do something else with it.
Two questions on that. So one is there's a look back, right? So you said emergency. Most people come when it's too late. Hey, mom's heading to the long-term care.
Sure.
What do we do? Well, there's a 5-year look back. And then the second thing is, if you can put that house into a trust, right? Is the person, the grantor, the person putting that into the trust, are they able to rent that house out and now receive the income from that to live off of?
Yeah. So a couple of things there. So in New York State, every state, because Medicaid is sort of a federal state shared program, states have different regulations. But in New York State, we have a 5-year look back as it relates to if you need to go into a facility. Okay, so if you got diagnosed today and tried to apply to Medicaid, then transfer the home out of your name tomorrow, and then the third day apply for Medicaid. Medicaid is you have to produce 60 months of documentation. They're going to say, hey, you tried to dodge us. We're going to apply a penalty period, and it can be depending on the size of the asset that you move, the value of it. It can be a very extensive penalty period. However, for in-home care in New York State, there is no look-back period.
Okay.
So if you have medical needs that can actually be treated in the home, you can get the diagnosis, unfortunate diagnosis today. You can transfer the home out of your name tomorrow. And the third day we can apply for Medicaid. And depending on the rest of your assets, you may actually be able to qualify to get a home health aid to come into your home that's paid for by Medicaid.
And hope and pray that 5 years is long enough before you have to move into a long-term care facility.
Correct.
Okay.
And again, so it's all going to be based on kind of what your medical needs are. My grandmother could not have stayed in our home.
Yeah.
You were fortunate enough to where your family member could, right?
Yeah.
So, but the problem is we don't know what we're going to be faced with from a
Sure,
medical perspective.
absolutely.
The second question that you asked around kind of income from that irrevocable trust and using a home. So you're going to want to place somebody. You can't be the trustee of anymore because you can't control that home. So your trustee could potentially rent out that home and get income. I discourage my clients, the seniors, from getting that income from whatever rental or whatever income is coming from that home, because there is an income test under Medicaid as well. And so any income that you're getting from that is counting against you on the income test side. So you have to be...
the income coming through the trust, though? Wouldn't that be taxed to the trust or no?
Well, it's not about taxation. It's about if the income stays in the trust, that's fine. But if any money is going back to grandma in that transaction, then that is income to grandma. That has to be claimed to Medicaid, and Medicaid may say, "Hey, you're over the limits there." But otherwise, if you do want to get income from it, that's fine. Just none of it should go back to grandma. It should either stay in the trust or go to whoever the lifetime beneficiaries of that trust are.
So let's switch a little over to the special needs trusts.
Yeah, so special needs trusts are trusts that are set up for family members that have special needs, have developmental disabilities, or whatever it may be. And these trusts can be configured to where you can preserve eligibility for government benefits, as well as provide a stopgap of needs provision for that individual. So, for example, there are, whether it's Medicaid or financial assistance, whatever, under state laws,
Even food benefits.
even
SNAP,
food benefits, right?
Yeah.
So, a good special needs trust says those benefits are going to pay first. This money is not going to be available until those benefits have been paid, and we're going to have an independent trustee who has sole discretion over those trust funds. So as a result of that, they wait for the government benefits to come through, and then they can drib and drab money out of the special needs trust as necessary to provide for the well-being of that person, but also in a way that that trustee has to be smart about what the rules are to ensure that you don't trigger ineligibility in future years, right?
Yeah.
So, those trusts oftentimes, they're often funded with life insurance. Kind of get a big bang out of that transaction.
So oftentimes those trusts are sitting with no money in it.
Or a very little amount.
Very little.
Very little, because the parents are caring for the child, or grandparents, whatever it may be.
So this is not a lifetime thing where you're alive, your kids, unfortunately, if they're disabled, we're talking about, God forbid something should happen to you who's caregiving for the disabled child, and you pass away. That's what a special needs trust would be for.
Correct.
And
Exactly. And I often recommend them to younger parents who have children, let's say with an autism diagnosis, right?
Yeah.
So to where they have relative certainty that they're going to have needs going forward. If mom and dad unfortunately got hit by a bus, and then you've got two or four, whatever, it happens, right? So how is that child going to be cared for going forward, given that they have these special needs? And so those are you can do it for other types of, other families and other configurations. But if you or somebody that has that sort of situation, definitely for younger parents, I really, really encourage them, because they still have insurability.
Yeah.
They can still get massive life insurance policies that can fund these trusts.
Yeah, and oftentimes I do get phone calls, emergency calls, saying, hey, is there any way you can help out my friend? They just lost their husband and they have these children and it's too late, right? And so that's why it's so important. And I think, most people look at, can I afford an estate planning attorney, right, to do all this stuff? And I always say, go talk to them. Right, because they're going to give you an opportunity to find out what the cost would be to set up everything and have a consultation, right? And you just don't know. So knowledge is power. That's why we do these podcasts to provide this information.
Of course.
What about family limited partnerships?
Yeah, so these mechanisms are often used. Family limited partnership is often used when there's a family business that you want to pass down, and you want to be able to slowly kind of phase in the younger generation into the business. And so what you do is you establish a family limited partnership, and you can transfer whether it's stock, LLC shares, whatever it is, into that partnership, and then over time, slowly. So you have the older generation are typically the general partners or general partner. Let's say it's a guy and he's got controlling the shares and he's got two sons, right? And he's like, the two sons are going to take over the business, but I don't want them taking it over right away, right? And so you can place the shares in there, and then over time, every year under current law, we each have a $19,000 annual exclusion from gift tax, and that does not count against that taxable estate. And so you can, oftentimes these shares that you're giving have a very low value, and so you can every year give $19,000 worth of stock or shares to limited partners, to that younger generation, and then eventually they get big enough and you are ready to retire, they are big enough shareholders, they can actually take over the business. So it's a way to pass it on, but also maintain some control.
And that would be for more small business owners. And then we also talked about like buy-sell agreements, entity purchase, wait and see agreements. So we'll have another whole podcast on businesses, right?
Sure.
Because there's a lot of information out there, and so it doesn't necessarily need to come from generational wealth. Maybe the generational wealth has come from a business.
Yeah.
You drive around Mamaroneck, and there's plumbing businesses that have been here for 150 years. You always hear of the biggest one I remember hearing was the owner of the Miami Dolphins. Where they had to actually sell the team to pay the estate taxes, right? And that was obviously a big mistake because of the fact that there was ways to prevent that. So if there was one important thing that we can tell our listeners today that you would want to make sure that everybody understands about advanced estate planning, what would that be?
Well, it's that when you're trying to solve these problems, it's a math problem. It has to do with taxes. And you need to think about any transaction, anything that you're doing. There's estate tax, there's income tax, there's property tax. And oftentimes when you try to solve one problem, you may expose another. So it's very hard to do on your own. Hire an attorney to actually go through these things. It's really worth sitting down. And unfortunately, not enough people do it. And they end up funding the causes that the government wants rather than the causes that they care about.
Yeah, and if anybody wants to look it up who's listening, apparently NVIDIA's CEO, Jensen Huang, reportedly used an intentionally defective grantor trust to pass depreciated stock while paying income tax personally, and he maximized the assets for the heirs.
Correct.
So that was a positive story, right?
Very much so.
Michael Jackson had a poorly funded trust, and the lesson is he had a trust, but he didn't fund it correctly. And the outcome was the estate went through probate, costing time, money, and privacy.
Massive taxes, too.
Massive taxes. So there are so many examples that we could provide of good stories and bad stories. I think ultimately to our listeners, if you have wealth and you might think it's nothing, but it could be something, reach out to the estate planning attorney like Kylan if you have questions. It doesn't hurt to ask, and make sure that if there's an opportunity to protect your wealth, to make sure it goes to the next generation, that you're doing those things before it's too late, right? So, Kylan, how can our guests get in touch with you.
Absolutely. So www.secureyourlegend.com, 914-714-4227.
Great. Well, thank you so much for coming on. This was extremely well. I'd love to have you back and talk a little bit more about business estate planning. That would be really great
Let's do it,
for
Rich.
our business owners. And if you have any questions and you feel like reaching out to Kylan, please give him a ring, or you can always reach us at hello@enrichlifepodcast.com. That's our email address, and I'll be happy to make a connection with you, as well as comment on our social media posts. Please share, like, subscribe to this podcast. Make sure that we get enough listeners, or as many listeners as possible, to really grow this podcast. It's very beneficial. You can see us on enrichlifepodcast.com, and we are also on all the major podcast platforms. So check us out. Thanks so much, and have a great day.